Sir John Templeton has said, for 100 years, optimists have carried the day in U.S. stocks. Even in the dark 70s, many professional money managers and many individual investors, too, made money in stocks, especially those of smaller companies. He also stated that there will, of course, be corrections, perhaps even crashes, but over time our studies indicate stocks do go up as national economies become more integrated and interdependent. As communication becomes easier and cheaper, business is likely to boom. Trade and travel will grow. Wealth will increase, and stock prices should rise accordingly. This has certainly proved to be the case over the past 100 years. But what happens if we are now approaching an event that we only experience once in 100 years? Well, let's take a look. Based on a recent article by Avi Gilbert, who is a widely followed Elliott Wave technical analyst and founder of ElliottWaveTrader.net, he believes that we may experience that once in 100-year event within a future wave. And as you can see from this chart here, Avi is looking for wave 3 off of the 2009 lows to top out. Now, wave 3 is right here. Here's a 2000 low at this point here, and wave 3 is at this point here. I'll go through some of the details here in a second, but follow me. Following the topping out here in wave 3, he believes we'll have a 30% correction down to this point here. But however, once that correction runs its course, he believes that we will see several more years of a rally before the bull market comes to an end. And he believes it'll rally up to this point before it comes to an end. But when it comes to an end, he feels that even worse, he believes that we will enter a bear market that can last as long as 20 years, rivaling the depths of the market during the Great Depression. So again, looking at this chart here, according to Avi, when we top out in wave 5 of 3, which is right here, the ensuing wave 4, ultimately bringing us down to this point here, is of the same degree as the Great Depression. And that was the Depression era wave 2 within the very long-term 5-wave Elliott wave structure. And while we know that history does repeat itself, Avi believes the probability of seeing a similar environment to that of the Great Depression will be quite elevated, especially as we approach the bottom of this C wave, wave 4 here. So let's go back and let's be clear here. Here's the bottom in 2009. Don't pay attention to these blue letters and numbers. Beginning here in 2009 was the bottom. So we had the first wave up to this point here, wave number 1. The second wave was a decline down to this point here. The third wave brought us all the way up to this point here where we are relatively currently. Now, Avi believes that we're going to have a 30% correction down here to number 4. That is the wave 4 of this structure. And the fifth wave up to here in the ensuing years, bringing us to this point here, which is wave 3 of a larger structure. Now, at this point here, he believes we'll go through a downtrend, bringing us ultimately down here to this wave 4, but it will start here, come to this point A in somewhere the middle of 2027. We'll have a rally up to this B point here, which is in 2032, late 2032, and then the downtrend here to 2037. I have a few issues with this wave structure. First off, it's very difficult to predict so far out in time here, 2037. The probabilities run very low when trying to go this far out in time. My other issue is within this wave here. We may be at a top, but I'm going to take a little bit of argument against a 30% decline coming here to number 4, which would be in, say, late 2019. So let's go to our charts and take a look at the current wave here, number 3, where we are currently. We are looking at the 12-year monthly chart on the Spiders SPY, and this is a pretty good proxy for the S&P 500. And according to the article by Avi, he's showing that we are at wave 3, the top of wave 3 here. He's expecting a 30% correction, which would bring us down to this point here, just above this level here, all the way back to, say, 2016, that sort of time frame and level. Now, in my humble opinion, and this is somewhat based on my discussion of the market in Friday's market update, I don't expect that we're going to come down this far. Number one, we're riding the 20 EMA here. We need to break through that 20. We need to break through the 50 EMA, which I think is highly improbable. And I don't think it's in the charts as I discussed with you on Friday's update. But let's just go through here. We see that the MACD is coming down, so there is a lot of territory that we can head on down here. But taking a look at the prior correction that occurred, say, in 2015 to 2016, back up to the price chart, that was only a correction of that amount here. We're looking to double that, maybe even triple that drop. I don't see that happening here. It's not showing up in the histogram yet. Again, we are continuing down and we can go even further. But I just don't think it's there. We have a relative strength that is fairly weak at this level here, 51.12. But we're going to have something like the correction we had in through 2007 to 2009 for us to get down that far, a 30% correction. I don't see it here in the stochastic. Yes, the fast line is moving pretty quickly down toward the 50, but it had an attempt here at a move upward. It did fail, but that's showing me that there is some fight in this market, and I don't think it's going to give up 30% that easily. I don't think the volume's there as well. Looking at the Williams, we are under 50. But again, we had an attempt at a bottom here, and I think we'll attempt another bottom. Perhaps this goes down a little bit further, but I think we're going to have another attempt here in not too long. But I don't see this moving all the way down into this low territory between the negative 80 and negative 100 level. It just doesn't seem to me that it has the elevation, and you've heard me talk about the stock market gravity, to bring something down this far. Breaking through the 20 EMA, that's a possibility. The 50 EMA, that's a very difficult possibility, and I don't think it's a probability. And moving through to this level, I just don't see it. So I've been wrong before. And Elliott Wave, in my opinion, is a good guide, but their time frames and their levels change all the time depending upon who you're following. I don't like that. So I'm going to stick my reputation here. I don't think we're going to go down this low. So if you want more information, go to Friday's stock market update, where I give you a little bit more information on reading the charts. So for today, that's ChewDog Charts. Thank you.